All right, so we got a catalyst for a little bit of a bump in volatility overnight, Thursday night into Friday. Was that the catalyst that will spark this pullback that we're expecting? And especially after seeing signs of weakness, started to point out yesterday. So I'm going to show you today what the beginnings of an intermediate pullback will look like, and whether or not I believe today was the start of that. So I'm going to break that down from a technical perspective based on what we should expect to see, and then that will give you an idea of what to look for next week to see whether or not we're going to continue to grind higher for the end of this run or whether this is the beginning. And the next week we'll have a little bit more selling. So we'll take a look at the technical aspect of that. We'll take a look at what's driving this long-term move and some positive signs we're seeing that again suggests we're at the beginnings of a long-term move. And then our trade idea kind of gives you an idea of how to lower your bullish deltas in your active trading portfolio with the idea of de-risking during whether or not we grind higher or whether or not we start selling this week. So today's trade idea kind of gives you an idea of what you can do. So let's go ahead and get started. Today is Friday, January the 4th, 2020. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500, and you can see we finished the week, with a down day, off the lows of the day, but coming off of this bombing in Iraq, we started the session down. In fact, if you look at the futures contract, we were down even more on the futures, and then rallied through the rest of the day off of the lows here. You can see the big drop. In fact, if you look at it on an intraday basis here, you can see the big drop overnight when the news came out, and we bottomed here around 4 a.m. my time, mountain time, and rallied significantly off the lows. So you don't really see that necessarily in the SPX because we were already coming off lows going into the open. So keep that in mind about this drop. So we continue to come off the lows after the open, and we finish off of the highs. You can see we filled in. We didn't quite fill in the gap. We closed at 32.57. The high here was at 32.46. So still finished with a little bit of a gap, but we closed most of that gap overnight. What it's done is it's kept the near-term line down. So the near-term line here is still unable to get to a higher high, and still also unable to get into the upper reversal zone, and has pointed lower now. So again, mature intermediate runs. So any intermediate run that's over 2 months long, when you start to see clusters and near-term divergences, they're signs of weakness. They're not immediate signs of reversal, but they are definitely signs of weakness. And so we're getting the signs to de-risk, to take risk off the table, at least on an intermediate pullback basis. We're not looking for a big drop, but you can see the green Fibonacci retracement lines here are set up for an intermediate pullback. And right now we can get just a 23% pullback and a 23% pullback and still produce a light pink shading, most likely because we drop below 80, and a yellow line because the 23% lines, depending upon where we close, because the yellow line would be based on the closing below that moving average. And again, that kind of a drop down to 31.63 from 32.58. We're looking at a 3% drop and about a 5% drop if we were to get a 38% pullback. And just to show you how significant that would be coming off of a 5% move. That would be here. Let's activate and move this up now to the top. There we go. So there's where the retracement, there's where your 23%, and then there's where your 38% retracement lies. So that kind of gives you an idea of, the type of move. This zigzag, it's very typical to get a pullback of that caliber. In fact, we need to I'll draw a Fibonacci retracement line here from this low point. So So all the way down here and then up. So you can see there where that low. So this is the near-term low, and you can see a 50% retracement of this move off of this last zigzag of that 5% rally would set us up right around that same 23% retracement level. So a drop to 3164, that's still another 60 some odd points away from where we're at right now. That would be kind of a very typical pullback, and it would be significant enough to bring the intermediate line down. Probably not down below 50, but it would be significant enough to give us a low point that we can bounce off of, about a 3% drop that we can bounce off of and get another 3, 4, 5% rally off of that and continue this run. Otherwise, you're looking at that 38% retracement. You'll notice here is lining up with close to the 78% retracement level, which would be the bottom end of a bigger retracement zone. And that would still be an area for right around that 3100 where we can stop, bounce off of support and move higher. And that would bring the intermediate line down below 50, would give us that intermediate pullback and then start a new 1 to 3 month rally. So if that ends up being what we get, then great, right? That's normal. That's an exhale. It's a typical exhale, and you can see the signs here are showing that the maturity and the signs of weakness are showing up. That would point to that type of move. Of course, we would need some kind of catalyst, and we got something overnight, Thursday night. You would need some kind of catalyst. All of these little pullbacks have some kind of catalyst involved with it. Obviously, not strong enough catalyst to produce selling that sparks a trend change, but one that will produce an intermediate pullback. We don't just come down on our own because buyers get tired of buying and sellers start looking for to take advantage of an overbought condition. Sellers can never really take advantage of an overbought condition. Buyers can buy the dip on really oversold conditions, but not the other way around. And you see a lot of tweets here lately about the fear and greed index, and I did a technical analysis class on this a couple of weeks ago. When you are starting bullish trends, they usually start with big bullish moves to extreme levels, and that's not a bad sign. And when you have extreme moves to the downside, that can be a really good sign for a bounce. But when you get big extreme moves to the upside at the beginning of trends, that usually is a good sign. Like these clusters here, that's a good sign that we'll get a good trend coming out of this. Let's take a quick look at the Russell 2000. You can see it's continuing to pull back towards its 30-day moving average. You can see the intermediate line's dropping, close to dropping below 80. The near-term line still not even above 50. So again, it kind of gives you an idea of the weakness and risk appetite that we might not be seeing until the last few days in the S&P 500. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked our video today. And number two, you want us to do it again Monday. So it's a quick way to give us feedback. It's our only survey we have. We take a look at those on every video. If you like our videos, let us know. If you don't like our videos, you don't have to click anything. Also, while you're down there, comment. What did you get out of the video? We always like to see what you're getting out of it. So comment down below. Join our website at marketscholars.com. There's a link popping out right there where you can subscribe to our site for free and get different content that we provide for our free subscribers. Follow me on Twitter for more content in between these videos from day to day, and join our Market Outlook Facebook group that we've created. Also on our Market Outlook page on our blog, if you're watching from here, check out the other links that are on the page, including our Market Outlook live videos, where we review all the trades that we make in these videos. We manage them all the way to the close. It's one of the most requested things I get from Market Outlook viewers is, hey, can you follow up on that trade idea that you did? Well, we do this in every Market Outlook live video at 3:30 Eastern. This link takes you there when you click on this image. Here's our classes coming up. I have a Q&A session coming up Saturday morning. And then we have a full schedule next week. You get access to all of our classes, all 8 of our trading rooms, excuse me, with our Plus subscription plan. It's a monthly price. You can get more details on it over here. Our premium plan gets you access to all of the trading rooms. And in addition to that, our 2 Q&A sessions, our coaching sessions during the week, as well as all of our custom content that we produce. We also invite you to engage with us on social media. Click this little heart. It opens up this window. You can like today's Market Outlook tweet. You can also click that thumbs up, like today's Market Outlook Facebook post. The more you engage with our content on these platforms, the more they will promote all of our content to you in your timelines, because they promote the content that you engage with the most. So we try to make it really easy for you here. You can also share and retweet this content to your followers as well. All right, back to the charts. Let's take a look at the long-term chart and how we're going to finish up the week. On the Hakinyashi, you can see a very good bullish week. You know, if I were to edit this and change it to where we're at right now, to kind of give you an idea of just how bullish we are on a weekly basis here. You know, again, we've been more bullish than this before, and you can also see too that a lot of times we get this bullish. In this case, this sparked the beginning of a 20-month flat run on the S&P when we got that bullish over here. 2013, coming off of these levels, we got this bullish, and it was kind of towards the beginning of a run. So kind of what I was talking to you before. Same thing over here coming out of this 2016 low point. Again, we were this bullish, and that sparked the beginning of this we continue to run even as we started to converge here and drop on the long-term momentum. We just slow down a little bit. So good run going on, good Hakinyashi candle. You can see this current intermediate trend, which is what we see here. We've been on for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 weeks. The typical run is 1 to 13, or excuse me, 4 to 13. So that's 1 to 3 months. So you can kind of see we're getting on into this, you know, towards the end of a 3-month rally, or over 2.5 months here. That's a mature run, and we're seeing some signs of weakness. Not enough to say, well, next week is a big reversal, because remember, the trend will reverse when you get a transition candle like this, or like this, or like this, or something like this, right? Or even if it's not red, one that looks like this. So this week was not a transition candle yet. So we'll watch out for that next week. The open for next week on the Hakinyashi is the difference between the open and the close of this week's candle. So if I were to look at 3202 is the open, 3236.28 is the close. The midpoint of that is 3219. We're trading right now at 3234. So we're going to open up next week with a pretty decently bullish candle. Won't be very big. You can kind of see here 3236 is the current close. So 3219 is right about here. So it's going to be a relatively small body to begin with. Then it's just going to be a matter of how far up do we go during the week early, and then how far low do we go during the week late. That's the type of week that would produce this kind of transition candle that would then be, okay, now we're going to get our intermediate pullback where we drop down on the intermediate line below 50. So you can see that's what we watch for next week. From a 3 green arrow standpoint, we're getting a lot of arrows now. That's very typical, again, of a mature run. You know, a sign of weakness when you start to get these arrows. But keep in mind, the other thing that you don't see on that chart here on the MACD is a lot of these arrows are occurring with very strong momentum. So even though the momentum is starting to pull back and the average is starting to roll over to the orange line, it's still very high. So it's not too common for this scenario where we just fall off a cliff from high levels. It's more common for us to diverge and to start to converge, for these lines to converge on each other before we reverse. So you can see there we've diverged. That's why the blue line's so high. I would expect that we would converge for a week or two before these lines to converge, before we really get that intermediate drop where we get the jump in volatility and we pull back, especially with buyers still in control. Stochastic still up above 80 here. The nice thing about that, if it does take a week or two for that convergence to occur, that buys you time to de-risk, not to completely take off all your bullish trades, not to completely put on bearish trades, but to lower how bullish you are, to reduce how bullish you are. So if we do get an intermediate pullback, it will bring your portfolio balance down like we talked about in the last video, but it won't bring it down significantly, right? It'll bring it down to a higher low that ultimately, when we form that intermediate low point and bounce, that your portfolio balance will bounce too. You can start to add risk at that point, and continue to move on in the direction of the long-term bullish trend that we're currently on. Let's take a look at the intraday chart. Again, remember we talked about how that 307 level, the 324, but see how that low point's moved up. Now it's going to move up again to over here to 312. So now we have a 12-point range. That's going to be below the 16 to 17.5% move. So we're buying ourselves some time, and you can see any kind of pullback here would, that from a, well, here's where your 3100 is where your the low point of the 4-week range. That's where the 38% retracement is. This is right around where your 23% retracement is in this level. So you've got some volume nodes there, but you've also got some very strong support right around 3200. So it's not a 23% retracement of that intermediate run, but it is a short-term support level that you can watch for. If we end up producing a transition candle next week in the Hakinyashi, look for some support there first and then down here. But we would start off typically with some kind of move to the upside first. So don't be surprised if we don't continue to fill in this gap to the upside first before we roll over and produce a lower shadow. If, like I said, if next week ends up being that transition candle. Taking a look at the volume today and the trading range, you can see the volume picked up, not surprising, up to 78 million. The trading range, again, it's above average, above 2, but you also have to keep in mind the gap. So we closed at 324.87. The high was at 323.64, so we had another point, a little bit more than a point. So you're probably about 3 2/3 there, and then you look at that in connection with the averages, and 3 2/3 is right in this area. So, and 77 million is up above the average too. And again, when these lines go up, that's when you get pullbacks. But with the ATR well below, like 1% is 3.2. So as long as the average ranges stay below 3.2, then the ATR will stay down below this 1% mark, which means that we're still on a strong bullish trend. So it's when your moves start to get to 4 or 5 points, when our ranges are 4 and 5 points, that's when we're going to be in the midst of an intermediate pullback. And that's what will bring these lines up more significantly, get this back above 1%, and then we can bounce and make our way back down again. All right, let's take a look at the volatility index. And not surprisingly, volatility started the day very high, much higher than this actually overnight. But it started very high. We rolled down. Not surprising, coming off of the highs. It's generally what volatility does, especially after a spike like that overnight. But then we rallied into the close. So you can see the low point developing in volatility. Now it's a matter of where's the next high point going to be. It's a relatively higher low. Are we going to get a relatively higher high, or are we getting to the high teens on the VIX? You can see that we're kind of threatening the lower end of the neutral range. Remember, not only does the lower end, but also the higher end of the neutral range will also act as a resistance on any intermediate pullback. And we might even get up to 1. If we get up to 1, we'll probably get up towards 20 or a little bit above 20 on the VIX, which would give us a great opportunity to sell that volatility, which we just don't get very often, as you can see. So don't get worked up. The media will get worked up if we get a volatility jump that high. But if we do, as we've seen before, that's a very, very good opportunity to sell volatility when we get that kind of a jump. And that would most likely be in conjunction with that intermediate line dropping below 50. So it would give us a new low point that we can start a multi-month rally off of, similar to the last time we jumped up to 1 and we jumped up to 20 or a little bit above on the VIX. All right, so to summarize, we still have a strong bullish trend. We are showing signs of weakness, that but not strong enough signs that you want to short this trend, because you can stay strong. We can converge and diverge for quite diverge with the indicators, but converge on those moving averages for another week or two as we develop either next week or the week after a transition candle in the Hakinyashi. So in that case, that would start our and a jump on volatility would be the signal that would start that intermediate pullback. So we haven't seen that yet. This little jump that we had wasn't significant enough to say this is the start of an intermediate pullback. But we could next week. So we'll keep our eyes, especially over the weekend, on the developments in the Middle East that could spark that volatility jump. Otherwise, use this time where we could converge for a while and transition between intermediate trends. Use that time to take risk off the table, to lower how bullish you are in your active trading. In your passive trading portfolio, it's not really an issue because the long-term trend is still easily intact. And there's no signs of weakness there from a long-term trend, or no signs of euphoria, like I mentioned before. But from a short-term, intermediate-term perspective, there are. So use this opportunity to lower how bullish you are, obviously in the direction of the trend, so that any intermediate pullback we get won't be devastating, which is what generally happens to novice and traders, especially, is when the market is the most bullish. That's when they get the most bullish, and then so the pullbacks end up being a lot worse than they should be. So we shouldn't happen to you. So what do you think? Do you agree with that assessment? Do you disagree? There's a link popping out right there in the top right corner of your screen. Click on that link. It opens up a poll. If you click disagree, comment down below on why. What are you seeing that tells you that you're either a lot more bullish or a lot more bearish than I am right now? All right, if you take a look at another sign of weakness in terms of this intermediate trend is how these asset classes have been performing. If you can see the strong small caps, crude oil, emerging markets all doing really well. Let me show you the rate of change here. Let's see, do I have rate of change on this? Yeah, I do. 6F. Let me show you the rate of change on the S&P 500. You can see we are above 10% on a 3-month basis, a 63-day. So that's a pretty decent move. If I were to edit this and show you 1202.52, which is where we're at right now, that's a pretty decent level. I mean, that's about how high we were in January of 18. I don't think this is the type of move that's coming because we're not that euphoric on a long-term basis like we were there. But you can see it, coming off of this low point when we got this bullish, kind of similar to coming off of this low, it sparked some sideways action for a while as the rate of change dropped down, and then we had some bounces off of those. So it's a pretty high level, not just in the S&P 500, but as I mentioned, crude oil is pretty bullish, right? If I were to draw that same horizontal line on a 20% basis, we're up 20% over the last 30 days. That's a relatively bullish level too that you've seen over the last few years. We've been more bullish coming off of more significant lows than we had. We're not, this low point that we've had wasn't as significant. When we're coming off of lows that are right around these levels, this is about as high as we get. Everything else is off of much lower low points that you can see here. So we had a pretty good strong week in terms of breakouts on crude oil, but just expect it to slow down now. You can see some of these other trends. You can see we just get little pullbacks when we've been this bullish, but we still continue to trend higher. You can see here we had a little bit more of a pullback, and then a little bit more of one. Right, we got here, then we got here, and then we went sideways, and we got bullish again. So we can still be strongly bullish at these 20% levels and maintain it, but expect a short period of slowing that will bring that rate of change down. And like I said, the Russell 2000 has also been relatively strong. Again, for coming off of this type of low, obviously we've been stronger when we've come off of a much lower low in the rate of change, but coming off of this type of low, getting to 12% is a pretty decent move in a 3-month period. And so expect that to slow down a little bit. Don't expect us to have the same type of move coming from this low point this point that we're at right now as we had coming from here. So again, just another sign of weakness that we could start to slow down. If I go back to that asset class comparison chart and just look at just this past week, right? It's a holiday week, so we didn't have very many. We didn't have this. We don't have as much of a move here, but this is it's a 3.5 day week, so keep that in mind. We have Monday, Tuesday, or actually a 4 day week, because New Year's Eve was a full day. Just a 4 day week here, but you can see with the jump, like going into today. Of course, gold was up today, and so is crude oil. But you notice gold was already up on the week, so it was already having a pretty decent move with some weakness in the dollar beforehand. The dollar stayed weak, stayed down, and even though the dollar was down, international stocks stayed down. You can see all equity stocks were down on the week, and safe haven trades were up. Like I said, even relative to equities, they were already going up, and you can see preferred stocks had a good couple of days here to end the week, and you can see also that high yield bonds were up on the week. We're up over treasuries until this safety trade today. So a little bit of a pop at the end of the week, and that's what produced some safety moves. But keep in mind that the moves that we've had coming out of this news in Iran, like for example the pop that we had in crude oil, we were already bullish. We had a 3-week good bullish trend on the Heikin-Ashi developing. So we were in this environment for a bullish move to facilitate this type of move. Same thing with gold. You can see going into this move, we were already reversing on gold after a period of transition and pullback. Last week was a pretty decent week on the Heikin-Ashi, and then we followed through with that. So again, that doesn't predict the type of breakout, because nothing predicts the news that we got overnight. But it does produce an environment to facilitate that type of move. Makes it easier for that type of move to occur. The dollar index, you can see, is turning lower, and that's actually a pretty good sign for risk asset classes, because they do better in a falling dollar environment than they do a rising dollar environment. You can see, even though the dollar was rising in 2019, the S&P did very well, but not the rest of the asset class, the risk asset complex. So if we get this death cross, which we'll probably get next week, and that sparks more of this type of move on the dollar, then that will be a very, very good sign, as it was for 2017. That will be a very good sign for equities, especially for international equities, as well as commodities, that we haven't seen that move in those areas during this bullish 2019 that we had, especially in the S&P 500. Let's take a quick look. You can see some developments here. If you take a look, today's ISM is still below 50. When you look at the ISM number coming in at 47. And also, too, to keep in mind, this construction spending, which is a little bit of a leading indicator on a year-over-year basis. You can see last month's number was revised from 1.3 to 3% on a year-over-year level, and then this month's was 4.1. So we're getting a bump in construction, even if the actual numbers right now, and this is a soft index because a survey, the ISM is still relatively low. So when you look at the economic surprise index, we're still negative, but we're not nearly as negative as we were in 2019. So this macro trends that we're seeing is we're bottoming. Remember, the actual indicators are still at pretty much lower lows than what we're at here, even if how the actual results are coming in compared to estimates, which is what this measures, is not nearly as bad as it was in 2019. So that's a sign of bottoming in that macro level. I've seen a lot of tweets that saying how low, like for example, the ISM was, and look out below, right? Well, we're already, no one said to look out below on this when we were in January or August of 2018 when it was really high, because that's when it peaked, and we've been falling ever since. So you start to see the look out below types of tweets and reactions to these indicators when they are at their lows. You don't hear them when they're at their highs, when we actually should be looking out below. So keep that in mind. And you can see too, the GDP estimates have really risen over the course of the past couple of months, up over 2% still, and we'll get another estimate on Tuesday. And what that's done, look in the last week alone, the odds of a rate hike have gone from 2% to almost 50% for odds for a rate hike in 2020, just one rate hike. But see, we went into the last week, we went in with a dovish bias, even though it's still relative, 50-50 odds that we get one rate cut in 2020. Now we're getting the bias towards the hike side, a 50-50 shot for a hike, and only about a 15% chance that we get one rate cut in 2020. So it's still, it's not enough odds that we for sure are going to get a rate hike. But the bias is shifting from a dovish bias where we are leaning towards the cuts to now we're leaning towards the hikes. And that's not a bad sign. That's not a bad sign at all, because when the Fed's raising rates, that usually means that we're on a bullish move, right? That the market's on a good run and the economy is growing and economic growth and inflation expectations are rising. Another good sign in this past week or so of this risk move on a long-term basis taking off is the fact that our discretionary has moved up, and technology and communication services, our three cyclical areas, are very strongly bullish here. And you also have financials and industrials and healthcare also kind of joining. Materials and energy are lagging behind, but remember, they're lagging as sectors to begin with. So they'll do better as that dollar really starts to roll over. And then staples, utilities, and real estate are also showing lagging, some pink and a yellow line with its dark green shading down here. But that's okay too, because those are your safe haven areas. So we've really kind of shifted towards how bullish these areas were in the last couple of months, and now these being our market leadership. And that's a more bullish market, right? Even though the market still was doing okay on the S&P, when these safe haven areas were the leaders, that's not typical, right? It's typical that they lead when the market's in a period of risk off mode, which we were on a global basis, and now it's not the case. And you look at the global markets here again on their 12 grid, and you can see on a global basis we've had a few areas where we've pulled back, but for the most part, dark green lines, dark green shading across the board. And with your cyclical areas in the U.S. leading that charge, very broad rally, very good bullish leadership. Again, signs that these are all signs of that we're on a good bullish move, even with expectations of the intermediate line pulling back below 80 or even below 50. When these start to get really bullish, energy and materials, then that's when we're saying, okay, the long-term move is getting mature, because, again, commodity prices typically are the last thing to rally in a long-term move. So one way to reduce your risk is, to reduce how bullish you are, is to add some bearish trades to your active trading portfolio, add some bearish deltas, just to kind of give you an offset, to not be aggressively bearish, but just add something so that if the market does get that intermediate line falling below 50, you have some bearish trades that can do well in that environment. So the stock I wanted to look at for that possibility is Harley-Davidson. Harley-Davidson, right now you can see, let's go to a 1-year chart. You can see we've got light pink shading, and the intermediate line's rolled over. The intermediate line never did. It got above 50, it never did get above 80. So if we rolled back down below 50, that's a pretty bearish intermediate high point. And it would be a lower high point than the last one we saw. So kind of a bearish pattern developing on hog. You can see we've already were in a bearish mode. We had a bullish jump, but we weren't able to sustain a lot of transition candles, and then now the possibility of a bearish candle breaking down below the 50, and the PPO also rolling over to the downside. If you look at the three green arrow lines, you can see we were above, but we never did get a surge, right? You get a surge when you get a good bullish move. Starts with a surge in volatility or a momentum, and then we kind of roll down. Well, this wasn't a surge up. It's a much lower high point, and the stochastics never did get to where the buyers were in control, and now they've rolled over, and this is rolling over, and the two lines are rolling down. So not a good sign. And in fact, the DMY tells you here the breakout above 25 on the negative with the positive already below 20. That's a good sign that we could start building into a bearish move, especially with us breaking down below the point of control on the 1-year basis. There's only one big volume node here, and we're breaking below right the midpoint of it, getting on the other half. So we have an opportunity for some downside move, especially with the earnings coming up and what that could do. The last time we had a knee-jerk reaction to the downside, we rallied out of it because the market was so bullish there. But the initial reaction was pretty down for this quarter last year. And we have a bearish technical environment setting into that so far. So what we did was we ended up buying the 35 put, which is not quite at the money. It's a little bit out of the money. But then we sold to help pay for that 35 put. We sold a 32.5 put. So that's even lower. This is what it looks like on the chart. So we buy, again, not quite, I guess it is at the money now, a little bit out of the money, and then sold a 32.5 put to help pay for that. It's a long put vertical spread. Again, with earnings, I'm position sizing smaller on the worst case scenario. Of course, the idea is we cut that loss in half too. If we were to bounce up, we're risking $528 on this. We keep that risk to $260. Keep our loss. We get out with a $260 loss. That's kind of our quote unquote stop order. But even if we don't, 528's half of normal for what we do in our classes. So that's a very small risk, but we have an opportunity here of a $1,500 reward for that $260 of risk. So good reward to risk ratio that would again help add some profits to our portfolios if the market as a whole pulls back and drags really weak stocks like this down more than others. So that's one example of a trade that I do in my directional option strategies, where we do a lot more trades like that. In fact, we did a few last week, even though we didn't have class, that I shared with our premium members through our real-time trade alert service. So if you want more examples like what we just did on Harley, then make sure you're coming to my directional option strategies class. Again, thank you all very, very much for watching. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That will take you to our Market Outlook forum, where you can open up any new thread and ask any question or comment on what we talked about in today's video. You can also reply to anybody else's threads there too. Remember to click that thumbs up icon, subscribe to our YouTube channel, and comment on the video down below. Follow me on Twitter for more content, and join our website at marketscholars.com, as well as our Market Outlook Facebook group. Have a great rest of your weekend, everybody, and we'll see you all on Monday.